And we are live.
All right, cool. We will give a minute or two to let folks join the webinar. But how you doing today, Adam?
Doing good.
Awesome.
Excited to talk about pro formas and rental analysis.
Yeah, we've looked at a few of these over the years.
Probably thousands.
Thousands. Definitely in the hundreds. You may have looked at thousands.
I think I have.
It's like we
I
got people
remember.
coming in, lots of people coming in. Hey, as you pop in, jump into the chat and say hi and let us know where you're from. Give us a little shout out there.
Where you're from and maybe what year you bought your first rental property.
Mm.
Or if you haven't yet, just say that. Be curious to see answers on that. What year you bought your first rental property? Adam, we slid in at the very end of 2008, if I remember right.
That's right.
All right, so we'll kick off here. Thanks everybody for joining. I'm excited today to talk about pro formas with my business partner Adam Rich, and we're gonna jump right into it here. So I think most of you know me. This is our third webinar that we've been running for property owners in Columbus, Ohio. I have a degree in electrical engineering. I write and talk a lot about property management, and I'm really excited today to have my co-founder on the broadcast, Adam Rich. He and I co-founded RL Property Management. We own some rental properties together. Adam, welcome, and maybe take a minute or two and introduce yourself.
Thanks, Peter. Yeah, so my name is Adam. I worked with Peter to start RL Property Management back in 2013, 2014. And also an engineer by background, and currently running an engineering firm here in Columbus. And when I was at the property management company, I focused primarily on running the maintenance department and dealing with the properties themselves. I love all things buildings, all things real estate, and been messing around with rental properties for a long time.
To say the least. Adam beat me to the punch and purchased a piece of real estate before I did. A couple years. He beat me by a couple years there. All right. So just a quick refresher. What are you watching? What is this? So this is an educational series. It's a once a month live webinar. And the goal is to help property owners be successful with their real estate investments. That's our goal at RO Property Management. And we surveyed our property owners at the beginning of the year, and we found out that 2/3 of you don't have the real estate investing knowledge or confidence that you would like. And so, as your property management company, we felt like we maybe could help out in that area a little bit because we have some experience as owners of rental property ourselves. And, we're dealing with hundreds and hundreds of these properties. We see them come and go. We see the financials. And we thought it would be helpful to share some of that knowledge. So we're doing a webinar every month in support of that. So what you can expect today is we're going to update you on our scorecard. So we give ourselves a scorecard as a property management company. We share that on our website. I'll show that in a second. Then we're going to look at a new build opportunity. And at the end of today's show, you're going to get to see how much that property is listed for sale for and how much we think as professional property managers it may rent for. And then we're going to get into the meat of our topic, which is building a pro forma, just a fancy way of saying how can you estimate the income and expenses on a rental property. And then last, as I said, we're going to reveal the purchase price and market rent. So here's our scorecard, and I'm going kind of quick because we got a really meaty topic today. I want to get into it. So our scorecard, again, you can see it on our website, but it's updated for last month. So every time you see one of these webinars, it's going to be updated for the last full month. So you can see some of the metrics that we think are really important to gauge ourselves in how we're doing for you, our clients, our property owners that we work for. So you can see some of those important metrics here. I want to highlight the occupancy rate. That's been clicking up a few percentage points every month. And actually, the up to the minute number here is actually 90% as of today. We just came out of our leadership meeting, and I'm really happy about that. It is leasing season, and we are moving units. We lease about 200 to 300 units every year. And so we see a lot of market rent data and days on market, and we know what has to be done to get a unit ready to rent so that it moves quickly to a great tenant. And I love seeing those occupancy rates click up because that just means more and more rent coming in for our property owners. If you have questions about any of these numbers, these KPIs and metrics, you can either ask them in the chat. We have some team members here that are watching live that can jump in, or you can always just shoot us a message. We'd be happy to talk more about these. All right, Andrew, do you want to talk about our investment opportunity today?
Absolutely, Peter. Yeah, thank you. It is not a new build, but it is newly remodeled. It's a property just a little bit south of our office in Gahanna. It's a 4 bed, 1.5 bath, 1530 square feet. And like I said, newly remodeled. So it's got a brand new kitchen, new everything, basically new appliances, got a nice 2-car garage in a really good neighborhood, the Pine Hills neighborhood down there. And then it is listed by Joe Peffer, a real estate agent that we work with Delicious Real Estate Group. And I picked this one because we'll reveal this later, so stick around for the price. But for the square footage and the layout and everything, it's a really good price for a house this size. So I'm excited to share this. And if you're interested in this or interested in seeing this house in person and maybe adding this to your investment portfolio, there is an open house this Sunday from 11 a.m. to 1 p.m. So
Awesome. Thanks, Andrew. And fun fact about Joe Peffer, the listing agent here, he's not only a client of RO Property Management, we manage his investment properties, but he also helped start the company. In order to start a property management company in Ohio, you need to be a licensed real estate broker, but the only way to get to be a broker is to work for a broker. It's kind of a catch-22. So Adam and I were friends with Joe, and he was gracious enough to help us get our feet under us there at Delicious Real Estate until I was able to get my broker's license and we were able to separate. But obviously still close with him, and we'd love to promote his listings and manage his properties. And I think this would be a great option for somebody to look at. But we won't really know until someone runs a Pro-Forma on it. So that's what we're going to get into now. So I'm going to introduce this topic, and then I think I'm primarily going to kick it over to Adam, and I'll kind of act as like the voice of the audience. And by the way, if you have questions as we go, pop those in the chat. I'm going to be monitoring that or the Q&A. So the question we want to answer today is, how do I know if a property is going to make money? So if you own rental properties, or if you're looking at rental properties to buy, you see thousands of these rental listings, and you get these fancy PDFs from these realtors, and you go to open houses and you see these nice brochures. But how do you really know what property you should buy? How do you know if a property is going to reach the financial goals that you have in mind for your rental property portfolio? So that's what we're going to answer today. So last month, if you watched last month, you may remember that we were answering the question, how do I know if my property is making me money? How do I know if my rental property is actually profitable and adding wealth to my household or to my overall balance sheet? But today we're going to move into a forecasting mode, and given a specific property, how can we analyze that property and decide if it is a good buy? Or given 3 or 4 properties, how can we analyze those properties and pick the best one that's going to generate the most cash flow and build the most wealth for us over time? And Adam gave us a little hint here. He says this calls for a spreadsheet. So Adam, I'm going to turn it. Actually, we have a poll. So Andrew, fire the poll off before we turn it over to Adam. So we have a couple polls throughout the presentations today. How do you currently evaluate potential rental properties? So I want everyone to vote. So a little pop-up should appear. Just answer with a check mark. How do you currently evaluate rental properties? We'll give a minute or so for maybe like 20 seconds for people to answer, and then we will see those results. I can't vote as a host, so that's kind of too bad because I would select an answer here.
And you can vote for more than one if you use multiple, kind of methods to evaluate rental properties. You can pick a couple in the poll there.
All right. So we see the results.
Let's do it.
There we go. Number one by far, 78%. I run my own numbers using a spreadsheet or tool. Great. So we're going to be in good shape to digest what we're about to share today. We got a tie for second place and make decisions based on gut feeling and experience. Some of the richest guys I know, that's how they buy rental properties. So there's something to be said for that. And tied for second is I haven't bought any rental properties recently / I don't know. All right, Adam, why don't you take it from here?
All right. So we'll get into some spreadsheet stuff in a minute, but I wanted to first touch on the fact that there are some rules of thumb out there that you may have heard of. There's the 1% rule, which is simply that as long as the monthly rent, is greater than 1% of the purchase price, it's probably a good rental property. Another good rule of thumb is what's called the gross rent multiple. And this is simply looking at, after collecting rent for many years, how many years would it take to pay off the original purchase price? And the rule of thumb was always that if the gross rent multiple was less than 10, that you were in target zone of a good rental. These are great metrics to kind of give you a sense of the property, but the problem is there's too much nuance to the overall numbers analysis. So that's what we're going to talk about today, hopefully, is give you some insights into some of those nuances as you analyze properties. So I put some notes here as to whether things are easy to calculate or easy to predict versus not. So for income is fairly easy to predict. Our property management company can give you a rent estimate. There's some online tools that can provide rent estimates. You can look at listings around the property that you're considering to see what other properties are renting for. Vacancy is pretty well predictable. And so you can determine, how long between tenants will my property be vacant. And then length of tenancy, I think, Peter, our current length of tenancy is about 2.5 years on average.
I think it's a little bit longer than that. I think our average. Okay,
Oh,
Lauren in the
Lauren's
chat
right.
just popped in 4.5 years. Yep.
So 4.5 years for our portfolio of units we manage. So that's the income side. Vacancy, typically you can count on 2 to 6 weeks be a rough vacancy. I like to generally be conservative when I run these pro formas and just assume 8 weeks, 2 months, as kind of a worst case. So that's income. And then we jump to expenses. I broke these down into 3 categories. The first one's easy to predict. We can get insurance quotes from our real estate or insurance brokers. We can look up the property tax, and I'll put a little caveat here on property tax. You always want to be thinking about what the property tax will be after the county and the school board finds out what you paid. So there is an issue where your property valuation can be changed based on what you paid when you purchased the property. So be careful about, there's great tools on, for example, the Franklin County Auditor's site where you can plug in what you are thinking about paying for the property, and it will tell you what your property tax will be, assuming that your property gets reappraised for that value by the auditor.
This is a big deal, by the way, and it's something that a lot of newer investors get caught by. Now, Adam, I know that there was a law passed in Ohio that slightly improved this situation. What were the details on that?
Right. So the details are pretty nuanced, but it did try to minimize how much the school boards could come after smaller transactions.
Okay.
So I think the number that comes to my mind is if if the valuation of the property is not going to jump by more than $500,000, then the school board cannot come after that reevaluation of the value.
So in that
Now,
case, it would get reevaluated on the normal cycle, and you
every
wouldn't get
3 years.
surprised. Yeah.
Yeah. And I know that this is still happening. I've seen school board cases filed very recently against valuations for properties that went up in value more than 500,000.
Got
But
it.
nevertheless, that's a nuanced issue. You should really consult with your attorney um, regarding the potential of that happening, because it's still a pretty new law, and the school boards are pretty aggressive about getting their money. So utilities, utilities really, if assuming the tenant is covering the utilities while they're occupying the property, we're really just thinking about maybe the utility costs that you might have while it's vacant between tenants. Property management, we can give you a quote for what that costs. You may know already. And then association assessments. These are from condominium and homeowners associations. You can find out what they are currently, and you can generally assume that they're going to increase roughly at the inflation rate, possibly a little bit more.
I do want to interject that next month's webinar is all about associations. So
Okay,
if you own a property, if you own a rental property in an association, or even if you live in an association, or you think you would ever buy a property that's in a homeowners or a condo association, you're going to really get a lot out of next month's webinar, because we dive all into the details and the risks and the costs, and it's going to be good.
great. Let's jump into item B. So item B are things that require a little bit of effort to predict, but you can still get pretty good numbers. You can gain some confidence in these numbers. So the first one is capital expenses and reserves. So this is things like, in 10 years, I'm going to have to replace the roof because it's already 15 years old. Or, all right, the air conditioner unit is 10 years old, and I know that year 15, I'm going to have to replace it. These replacements can be estimated in advance, and you can figure out exactly how much you should be saving every year or every month to make sure you have enough funds to cover those items. It takes a little bit of work, a little bit of legwork, a little bit of math, but it's possible to predict this really well. And then the second thing is mortgage, which is simply just making sure that you have good conversations with your mortgage, your lender, your mortgage broker, to find out what are the rates like, what are the terms like, how long is the amortization schedule that are available to you. That will help you pinpoint how much your mortgage is going to cost you. And then the last bucket is possibly where the real money is made, because they're hard to predict. You can't predict them. You can only estimate them based on experience and your best guess. These are things like repairs. It can be difficult to determine what repairs are going to occur and what they're going to be for and how much they're going to cost. It's also somewhat difficult to determine turn costs, because you don't know how much the property is going to deteriorate during the occupancy, how much tenant damage there's going to be. Turn costs can be a little bit tricky, but the property management team can certainly give you some insights into that if you're considering a property. Travel costs, if you are going to be living far away from the rental property and you anticipate having to come into town, it can be possibly difficult to decide how many times per year you're going to have to come into town. And then finally is the professional services like legal and accounting. On a best case scenario, you'll pay your accountant to file the tax returns, and you should be able to predict that pretty well. And then on a worst case, you might need to hire a lawyer for issues that might come up with the property.
Great. Thank you, Adam. And I want to mention that we're actually going to share at the end of the presentation the actual pro forma that you and I use, Adam, when we evaluate rental properties. We kind of clean that up a little bit and we have it available as a Google sheet. And so this is going to become very real for you. It's basically what you see on the screen here on this slide, and which Adam's going to about to go through it in detail. But um, that's just a little perk for those who are tuning in today.
Yeah, what I'll do here is just give an overview, quick overview, and I'll try to tie some of the things we just talked about into this spreadsheet. So you can see off to the left, we look at the income, we look at the expenses, and we look at the return calculations. Essentially, how much money do we anticipate making with this property? And then on the right, we have some data around the property itself, the loan that we anticipate getting, and then the initial costs, which will incur during closing and shortly after purchase, and then our estimates of appreciation. So in the income section, there's some entries there in yellow, which will help you calculate how much per year is turnover going to cost you. And then under the expenses, you see a lot of the items we talked about on the previous slide: utilities, travel, property taxes. And then you can see we have a line item there called yearly maintenance, regular per square foot. And what this is we typically have a understanding from previous years worth of repair spending and maintenance spending, how much that's going to cost. And we do it based on the square footage. So in this example, we say that every year we're going to spend 75 cents per square foot on maintenance and repairs. And then the line below that, the average turn cost, that's what we anticipate, of course, each turn is going to cost to complete. And then I think I'll jump down to the return calculations. I'll just run through these one by one. So the first return calculation is net operating income, and that's simply how much cash is left after you've paid all expenses except for the mortgage. And then the next line item, the debt service coverage, that's using the net operating income, how much of the mortgage payment are you covering? So in this example, the mortgage payment is $572 a month. And you can see where our net operating income is about 108% of that mortgage payment. And that's a great number to know because banks will typically want to see that number to be about 1.2, 1.25 minimum. Make sure you're going to have enough cash to pay the mortgage. The next item is the cap rate. Not a very useful metric other than maybe to compare with other properties. It's just how much the net operating income is relative to the purchase price. The next item is the cash flow, which is how much cash do you end up with in your pocket at the end of each month based on these estimates. And then the cash on cash returns, just the percentage return of that cash based on the amount of money invested. And then the holding period is a number to help calculate the next figure, which is essentially the internal rate of return or the overall rate of return. So the internal rate of return takes into account not only the cash flow, but it also takes into account the pay down of the principal on your mortgage, and it takes into account the appreciation of the property. So if you hold the property for 10 years, you take those three sources of income into account, your overall return will be about 8.3% per year. So that's I think, good summary of the spreadsheet there.
Yeah. So this is what we do when we look at a rental property to buy. We pull up this template and we start filling in these numbers. And I don't know what other people do, but that's what we do. And I don't think it's steered us wrong yet. It seems to me that a lot of buyers are not performing anywhere near this level of analysis, and they're just sort of looking at the rent, looking at the mortgage payment, and taking a guess. And the details really matter with all these numbers. And the more accurate you can get, the more of these numbers, the less risk your investment will have. One of the things that a lot of real estate investors focus on is returns, and they forget about risk. If you think of like an extreme example here, would be like a roulette wheel. Like if you met somebody who won at roulette and their return was really good, if all you were looking at it was like the best way to make a return, you would be on the roulette wheel every day. But what you're missing there is the risk. And so every real estate deal carries with it risk. The risk is much higher than just buying a stock, or I should say like an index fund, but the returns can potentially be higher as well. And so your job when you're analyzing potential properties to buy is not only to evaluate the return characteristic of the property or the investment, but you also want to characterize the risk. And a lot of the numbers here, the more tightly you can estimate those, the lower your risk becomes. In other words, if you conservatively estimate all of the numbers on this spreadsheet, the risk of missing the return in any given year goes down if you were to like smooth it out over time. So that's what I think about with this pro forma or with this spreadsheet is that it's a way to reduce the risk when you're evaluating properties to buy.
Another thing I'll add, Peter, in addition to risk, you also want to consider other opportunities. So I'll give an example. If you carefully and spent a lot of time filled out this spreadsheet and you found presently that your internal rate of return, which is like your total return after appreciation and principal pay down and cash flow, if you found that your internal rate of return was over a 10-year period was going to be 4.5%, you would want to just go and buy a CD from the bank right now because you would have to do zero work to own that CD and you would earn 4.5% for 10 years and you would take no risk. So you really want your internal rate of return to be higher, much higher than the no risk option that you could alternatively purchase.
Yeah. The other thing about single family rental properties or very small multifamily properties is that the my friend Moses Kagan likes to say that they present idiosyncratic repair risk, which basically just means that in any given year or month, you can have huge swings in the expenses. You know, you could have an AC unit go out, you can have major damage of some kind, water leak, and so that can be psychologically difficult for a lot of real estate investors. Paradoxically, the more units you own, the smoother the numbers become on a month by month and year by year basis. So for any given single family rental, the numbers will never actually look like they do on this spreadsheet. But the longer you own it, the more the overall numbers will converge, like the averages will converge on what you see here. So that's one thing to bear in mind as well is, you know, you've got the risk component, but you've also got just the psychological challenge. And we talked about this on the prior webinar, the psychological challenge of making it through some larger expenses or two turns, 2 years in a row, knowing and taking comfort in the law of large numbers, which says over time, you're going to experience, you know, less of those expenses and longer occupancies.
Yeah, and Peter makes a great point. I mean, Peter and I can speak from experience. There's been times we've had rough rough months of spending, but over a 10 plus year period, those months kind of become irrelevant and have become irrelevant to us.
And one of the things we're trying to help our clients do is zoom out and take a broader perspective on those things and we're trying to do that not by just pointing the finger and saying you're looking at it wrong, but we're trying to provide tools and dashboards and language and just ways of thinking about property with a longer time span that should be really helpful for property owners, for you our clients. So you can let us know how we're doing there. We've got some exciting things that are going to be rolling out over the next few months that are really going to add to this. All right, let's take another poll. What's your biggest challenge when evaluating cash flow? So when you look at the spreadsheet on the prior page, what for you is going to present the biggest challenge in populating those numbers? All right, Andrew, have the votes stopped coming?
Got a couple more trickling in. It looks like we've had about the same number as the last poll, so we can end it and take a look at these numbers. Share these.
All right. Number one challenge by far is accounting for all the expenses. And that's a great answer because that is a big challenge. Number two, with 33%, assessing long-term risk. And then number three was understanding financing costs, with rent income being the last answer. So yeah, we're always happy to do a market rent analysis. We call it an MRA for short here inside the walls of the management company. Basically, we'll give you an idea of how much we think your property is likely to rent for given today's market conditions and the current, property condition as best as we can understand it. So we can help you reduce that, the unknown part of the income side.
Yeah, and I see on this poll that expenses and long-term risk are both kind of the higher options chosen. And I think both of those, we can look back at the idea of estimating your future capital costs because that's an expense and it's a long-term risk issue. If you forgot that in 8 years you're gonna have to replace $1 million roof, that's a big deal. I use a simple example for people sometimes, like right now it costs about $15,000 to renovate a bathroom. And if you assume that every 15 years, you're probably going to need to renovate that bathroom to keep it up in terms of looks, that's $1,000 per year of expense that you're going to have to account for.
What if the house has 4 bathrooms?
Then you're looking at $4,000 a year. And which is interesting, when you look at homes, larger homes with a lot of bathrooms and large kitchens, the yearly spending can start to creep up into the $4 to $5 to $6 per square foot for capital costs.
Mm.
So you take a 4,000 square foot home with a $5 per square foot capital cost or reserve, money you need to save. That's 20 grand a year of savings that you should probably be stocking away to account for everything that you're going to need to do over time. This is why you see a lot of very outdated houses because people just they don't want to spend the 20 grand a year on redoing bathrooms and such.
Yeah, and you always see folks either take one of two routes. It's when it's time to sell, they either spend a bunch of money to update everything,
Yep,
so it's ready for market, or they just say, I'll take my hit on the sale price and let the buyer deal with it.
that's right.
All right. So risks and cash flow. So we've got some more analysis here, Adam. Why don't you walk us through these?
Yeah. Well, I put this little sort of example on the right of what it looks like to estimate those capital costs. It's a pretty simple calculation. The only thing that I don't show here is adjusting for inflation, but you just look at each component that has a long life. So a furnace can last roughly 25 years. So every year you with a $1,500 furnace, you should be saving about $60 for that, future furnace replacement. And you just do that for every item. But the real depth here on this slide is risks and cash flow. So I'll jump right into that. I always recommend that people keep 6 months worth of rent in reserves to cover things like furnace replacements or any unexpected items. And I want to talk about risks, just general risks with rental properties. I have 4 of them here. If you look at rental properties that have lower rent relative to the market, so low rent units, those rent payments have higher credit risk. You're more likely to not get paid by the tenant. That's a good example of a property risk. The next risk is tenant damage, just abuse of the property beyond normal wear and tear. Legal claims. So if the tenant decides that they, for whatever reason, were wronged, they could have a claim against the landlord or the property management company. And the last thing is bankruptcy. I want to point out that tenants do from time to time file bankruptcy, and bankruptcy courts will essentially force a landlord to allow the tenant to remain in the unit with no rent until the bankruptcy case has been settled and decided. So that's my 4 risks. And then the third item here, property tax adjustments, we talked about a little bit earlier. Just be really careful about how your property tax liability could change after you've essentially told the world how much you paid for the property.
Yeah, it's not the case in every state, but in Ohio, what you pay is public record. Yeah, we've seen all of these risks here at RL Property Management. I think we've had our hands on thousands of units over the years, and we've dealt with bankruptcy filings, many legal claims, and tons and tons and tons and tons of non-paying tenants and tenant damage. I think the big one here, I mean, the legal claims in bankruptcy, it's really hard to do anything about that. There's not much you can do to prevent it other than, in the legal claims, making sure you have a good insurance policy and you have your deductibles where you want them. Bankruptcy, we do our best on tenant screening to reduce the risk of that. But the sort of non-payment of the rent, which can lead to an eviction, and then tenant damage, those are the ones that we lose the most sleep over here at RL Property Management, and those are the ones that we've spent the most time trying to reduce the risk for our property owners. It's one of the challenges of running a property management business is a lot of the things that we do for you, for our property owners, are invisible. It's like things that didn't happen that could have, but didn't because we did a good job. And to sort of put our money where our mouth is, I think if you're listening to this and you're a client of RL Property Management, you know that we don't charge a leasing fee. Almost every property management company charges a leasing fee, which is usually like 1 month's rent to find and place a tenant in the property. And that's charged every time the property management company places a new tenant. And when we founded the company from day one, we decided that sets up a bad incentive for the property manager, and it doesn't align our incentives with yours as the owner. And so we decided we were never going to charge that leasing fee, and we still don't 12 years later. So what does that mean? Well, if we place a tenant in the property who doesn't pay the rent, hence the no pay, and gets evicted, we have to find and place a new tenant in the property for free for you, the owner. And so our incentive is to find great tenants and keep them in the property for you as long as possible, which results in the best financial outcome for you because, as we looked at, turns are one of the most expensive parts of owning a rental property. So if we can reduce turns, if you own property for 15 years and you can have 3 turns instead of 5, that's a massive, massive savings. So that's one of the ways that we reduce the risk for our property owners is that we take on some of the risk of a bad tenant. And in doing so, it means that we're very rigorous with our tenant screening because we do not want a tenant to get evicted. That's, that we feel that pain very acutely. And I think I've always liked that arrangement, and I think it's fair.
Peter and Adam, we have a question here from Tim Swartz asks, does this 6-month reserve recommendation that you're talking about here change as your portfolio size increases?
What do you think, Adam?
Well, I think saving 6 months worth of rent for each unit that you own is a really good start, like a really substantive go at preventing issues with cash flow. But as the portfolio gets larger, I think it's even more critical to really understand your future capital costs, your future CapEx, replacing those long-lived items, um, and then adjust the reserves here, adjust the 6 months to what it needs to be after you've done that analysis. That'd be my answer.
It's kind of like a cash flow forecasting activity, if you want to put it in like business ownership terms.
Yeah, I mean, if I think about our portfolio of properties that we manage right now, having the average rent we showed on the screen earlier, 6 months worth of rent is about close to $10,000. And $10,000 will cover most things for your typical rental property. Roughly a new roof, roughly a completely new HVAC system, certainly any kitchen appliance, as an example.
Awesome. Thanks, guys. All right.
All
Well,
right. Yeah, go ahead, Andrew.
Yeah, so I'm going to take just a couple minutes here to talk about this brand new report that RL published just last week. And I wanted to include it in today's webinar because when it comes to making some of these informed investment decisions that we're talking about today, in addition to everything Adam and Peter have shared, like income and expenses and building this pro forma and evaluating an individual property, it's also important to understand kind of the bigger picture, what's going on in the market, right? What are home and rent prices doing? Which neighborhoods do people actually like to live in? What laws and regulations might impact the properties you buy, right? Well, this report that we put together includes all of that information and a lot more for the greater Columbus area. It's totally free, so you don't even have to give us your contact information. Just scan that code and you can read or download this report anytime you like. It's up to date for what's going on in the market right now this year. And there's a ton of valuable information that I think you'll all enjoy in there. As you know, so if you're serious about wanting to buy more investments right now, this is a good place to start before you get into some of these pro forma evaluations on individual properties. So go check that out.
This is awesome, Andrew. And I frankly, I can't believe we're giving this away for free because this is, represents a lot of value. I think the information in here can really swing the value of your portfolio by tens of thousands of dollars, if not more, if you kind of carefully read and absorb some of the details that we're sharing in this. And I love that we now have the ability to produce these kinds of research-driven reports and make them available to our clients. That's
Mm.
really in support of our mission of helping property owners be successful with their real estate investments. So love it. All right. Summary. Take us home, Adam.
Okay, I put a lot on here, but this is a great summary here, I think. So first one is when you're thinking about your property purchases, know your goal. Are you really after cash flow? Are you really after appreciation? Principal pay down is a good consideration. And then tax savings. We didn't talk about tax savings, but they do exist for rental properties. And um, just make sure you understand which of those four items you're really after, and maybe more than one. The next item I put here, new building. The great thing about new buildings is for probably about 15 years, you'll have no capital costs, no new roofs, no new furnaces. But year 15 to 20, you're going to start paying some bills. So just be prepared for that.
Adam, I talked to the owner of a property management business this morning who has 350 units under management, and he said 90% of the units they manage were built in 2020 or newer.
Wow.
Yeah.
Wow.
What a dream.
Yeah, that'd be easy going. I think those owners, hopefully they're saving some money.
He goes, yeah, we really haven't had to do much. I think, one time we had to replace an AC. Like one time he had to replace an AC. Like he was like really thinking if it was like if they even really did it or if it was like just one time. I was like, oh my gosh, because we do dozens every year.
Yeah, I think probably more than that. It's maybe several dozen a summer.
Mm-hmm.
Next item on here, talk to your bankers. Keep in touch with them. Make sure you understand what the mortgage industry is looking like at any given time. Next one is be realistic about turn costs. Um, Man, we've seen turn costs go from, now looking back, very cheap amounts to double and triple those amounts over the past 5, 6 years. Um, Kind of crazy. So talk with the property management team, find out what turns are costing these days, and make sure you assume that in your pro formas. We talked about this earlier, but repairs are the hardest cost to predict. This is the one that always worries me the most when preparing for pro formas. Um, when I look back at simple single family rental properties, smaller, your typical 2, 3 bed, 1, 1.5 bath, we have found that 50 cents to $1.25 per square foot per year is a generally rough guide for how much repairs and maintenance cost you'll have. Number 6 here, we talked earlier about the lower rent properties and how those rent payments are somewhat could be a credit risk. So the number 6 is really think about your preferred property class. You want a class A property, a class B, a class C, and really understand what that means, what you're signing up for as you make your purchase. Number 7, one of the biggest shifts that people have to make when they buy rental properties is they have to switch their thinking from the property being a home to being an asset. I said in the notes here, think like a private equity firm. I can tell you, like, no private equity firm owner is staying up at night worrying about some tenant in a different state that damaged their front door. Like they they think of it as an asset. The asset's either producing returns that they like or it's not. They don't really think about how the front porch got ruined because the dog was scratching. They're just not thinking about that stuff. And the last one is, we've mentioned it earlier in this discussion, but this is truly a long-term game. Um, there are certainly people out there that do quick turnaround purchase and sales of property, but if you want to own rental property, I think the best way to do it is long-term. Let the appreciation and the principal pay down work really well for you. Um, I tend to think in 50-year chunks. So what's this rental property going to look like for me in 50 years? So really try to think in decades, 10 years minimum, 20 years, 30 years preferably. Let's pay off those mortgages.
Love it. This might be my favorite slide. Let's close it out with a poll, and then we're going to find out how much that property from the beginning is listed for sale for and how much we think it can rent for. So when analyzing a deal, what's your primary decision-making factor, knowing what you know now from today's presentation?
People are excited to vote for this one.
And we're gonna shortly drop the link for the spreadsheet if you want to make a copy of that.
Get that ready. And looks like we've got everyone who is going to voting. Let's share this.
All the above, clear winner with immediate cash flow coming in number 2. So cash flow is still really important to a lot of people. That makes sense.
Mm-hmm.
Okay, Andrew, why don't you walk us through the secrets that we're going to now reveal about this property?
Yeah, so this wonderful property is listed at $259,900, and we did our own market rent analysis or rent evaluation that Peter mentioned earlier, and it came in at right around $1,900 a month. Give or take maybe $50 or $100 in either direction, depending on how things are going. But that is about where we'd rent it for. So. Depending on how much you could put down, and depending on and I would say go do a pro forma for this property if you're interested in buying it and see
Mm-hmm.
see what the numbers come out as. And depending on how much you put down and what your mortgage is, or if you buy it outright, you're looking at roughly $1,900 a month of rent potential income.
Mm-hmm.
So not bad. If you're interested in this, you can give our friend Joe a call. His number's right there on the screen. And if you want to see it in person, again, that open house is this Sunday from 11 to 1.
Great. Thanks,
And
Andrew.
I'll include, yeah, no problem. I'll include the address to this in our follow-up email here as well. In addition to all the resources that we've shared today. And you mentioned, Peter, putting that Pro-Forma template spreadsheet in the chat. I'm doing that right now. It's a Google Sheet, and you'll need to go to File and then make a copy so that you can use it on your own. But it's the exact same one that Adam showed us today. So.
Great stuff. So we have about 5 minutes left. If anyone has any questions, we'll stick around for a couple minutes and answer those. Appreciate everyone showing up for today's webinar.
Yeah, and then I'm also going to put a link to that property to Zillow here in the chat as well. So
cool.
And then you mentioned it earlier, Peter, but next month's webinar, taking place on April, I believe, 30th, the last Wednesday of the month. If you want to register for that right now before we forget, I'm going to put that in the chat as well. So a lot of links coming in hot. Go check those out. Check out that spreadsheet. Check out that home on Zillow, and then register for next month's webinar.
Adam doesn't know it yet, but I'm going to ask him to co-host that one too, because he knows a lot about associations.
Yeah.
Awesome.
Our firm, Criterium Lisquet, that Adam runs, does a lot of association reserve studies. So if you own a condo or a home in a homeowners association, every 5 years, you should be getting basically an updated analysis of the capital expenses forecasted into the future. And those are usually done by an engineering firm, and Criterium does a lot of those.
I'll put a link to Criterium here in the chat as well if people want to check that out.
Yeah, lots of good stuff we'll be able to talk about on that topic when you think about buying a rental property in an association. Lots to think about there.
Adam, why don't you share some of the other things that Criterion is able to do for rental owners that could be relevant here?
Sure. We do a lot of inspection work, so structural inspections, if you've got structural issues, if you want to have a maintenance inspection done, or what I would call like an itemized repair needs inspection, we can give you a list of everything that's wrong with the property as it sits right now and our recommendations. We can do full home inspections. So if you're buying a property and you want an engineer to do those, we can do those. And just if you're having any other issues with your property that requires an engineer, we can probably help.
Great stuff. Okay, we've got a quiet crowd today, but we had great attendance all the way through. Appreciate everyone coming out. It doesn't look like we have any questions, so we will give you back 4 minutes, and have a great rest of your week, everybody.
Awesome. Thanks, Peter. Thanks, Adam. See you later.
Bye all.
Bye, everyone.